Welcome, welcome. I thought the little countdown thing was happening, but actually it wasn't. Welcome. It is Wednesday at 5 o'clock, and we are here at Own Again, brought to you by Gersha Porter, your local realtor. I am excited to be here in front of you today. Hopefully, everyone is doing well. I want to just let you guys know I am praying for my people in Dallas with all of this power outages, etc. We are here in Baltimore bracing for some snow again tonight. And I'm just thankful that we could be inside. And I am still working, still delivering, still hopefully providing some value for you guys, my audience. So I am once again the owner of Porter Premier Homes, a team at Cummings and Company Realtors, where we eliminate confusion for buyers by giving them key strategies to unlock resources to buy their dream home. And you can search for your dream home at porterpremierhomes.com. And our topic today is one all about numbers. And get a paper and a pencil. You may want to use the note feature on your phone. You may want to look at this live again as a replay so you can write down some notes that might be relevant for you or someone else you know who is about to hit the market in terms of purchasing a home. Some of this information also is very relevant if you are thinking about refinancing as well. So if you've been around for a year or so, you've heard in the news, you heard from friends and families, neighbors, interest rates are the lowest that they've been in 30 years. And that has allowed the real estate market to just continue to boom despite the pandemic. So we have a huge group of folks who are out there buying homes. And then we have a lot of current homeowners who have been taking advantage of these low interest rates. And that has reduced their monthly payment anywhere from $100, I've heard, to around $700, $800 a month. So if you know anybody whose current mortgage interest rate is above 4%, drop me a message directly. I can connect them with one of my lender partners to see if refinancing right now would be to their advantage. There are also a number of current homeowners who don't realize that they actually have more than 20% 20% equity in their homes. They've owned them for quite some time, and their mortgage is less, 80% or less of the value of the home. And they can probably eliminate the private mortgage insurance that they're paying. And that private mortgage insurance can run anywhere from $80 to $300 a month. So that is also another savings that might be right there in your current budget and that you can maximize. So if you are a current homeowner and you haven't refinanced in a number of years and your interest rate is above 4%, shoot me a message and let's connect you with a mortgage lender who will be able to see whether refinancing would be of benefit to you. So thank you again. Come on in. Today, we are going to be talking about understanding loan options. So you say, well, why do I need to understand loan options? I love looking at homes. I love showing homes to my clients. I love talking about fireplaces and granite and stainless steel and locations that are walkable, all that kind of stuff. Love, love, love talking about that. However, without a mortgage loan, we can't buy a house. Now, I am in my 18th year of real estate, and aside from my investor clients, I've had 2 clients over all these years purchase a home with cash. So, yes, the majority of buyers must secure a mortgage or a loan in order to purchase their home. So, what I'd like to do today is give you some more information so that you can understand loan options. And as a plug, I will be doing a home buyer seminar, virtual, on Zoom on March 13th. And we're going to be talking about the hidden costs of purchasing a home, We'll be talking about loans and other money strategies. So look for that on my socials. I'll be advertising it very soon. Want you to make sure that you register. It won't be on Facebook Live. It'll be off of Facebook. You'll be able to ask questions. We can interact. I'll know who's talking to me. So please, if you have an opportunity, definitely sign up for that so that we can be of service to you as you move forward this year in purchasing a home. So, hey, Josephine, thank you so much for joining me today, part of my Own Again tribe. I love the support, and I really, really do appreciate you joining me live today. So, what happened? Need to catch up. So, somebody says what's happened, and I appreciate you guys joining me today. So let's go ahead and start talking about understanding loan options. And as I said, feel free to take notes, look at this again, send me messages to ask me about your specific situation. Okay, so let's just start by understanding that not all home loans are the same. Knowing what kind of loan is most appropriate for your situation will actually prepare you to talk to some lenders or for getting the best deal. So I want to arm you with information so that when you speak to the mortgage lender, you can ask some questions. You can make sure you're getting the best deal for your situation. So today I'm going to help you understand the different choices that you may have and how they will affect your monthly payment, your overall costs, both upfront and over time, as well as your level of risk. Now, jot it in the comments if you want me to bring one of my loan partners to one of our Facebook Lives. I'd be happy to do that as well. As a realtor, I try my best to stay in my lane. Clearly, I have a really good understanding of loans, but I am not a loan officer. And so I want to make sure that you understand that up front as I begin to talk with you, and that if you are interested in me bringing the expert on as a guest, please do let me know and we will bring them on. Okay, so first of all, let's talk about loan terms. What is a loan term? When we talk about loans, most of the times we think about a 30-year loan. And I have folks, when they look to buy a house, they're like, oh my gosh, 30 years, I'm 30 years old. That means that when I pay off this loan, I'll be 60. But it doesn't necessarily mean that. It really just depends on what your financial goals are and how quickly you want to pay down or pay off your mortgage. But most of the time we think of a 30-year loan term. But there are some other options, such as a 15-year loan. And there are some lenders that have some between 10, some have 20. Which loan term you have will determine your monthly principal and interest payment, your interest rate, and how much interest you'll have to pay over the life of the loan. So when we say life of the loan, we're talking over 20 years, over 15 years, or over 30 years. Okay? So there are short-term loans. They have a higher monthly payment, but typically they will run with a lower interest rate, thus a lower total cost. While long-term loans have lower monthly payments and generally higher interest rates and a higher overall cost. So there are a lot of first-time home buyers. They don't have a ton of money. They have enough for their down payment and they're comfortable with a monthly payment that might be similar, let's say, to their rent. Okay, so if they've been paying rent that's $1,300 a month and things have been pretty stable for them in terms of employment and outside expenses, they'll say, well, you know, Gersha, I'd like to stay around $1,300 a month on my mortgage. Based on that, the loan officer will then give them a scenario in terms of their purchase price, with the principal, the current interest rate, which are great. The combination of those two and some other fees will equal about $1,300 a month. And then we go shopping. So Although shorter terms may seem more daunting because the payment is larger, if you can afford it, there are two reasons that this type of loan term will save you money in the long run. Number one, you're borrowing more money and you're paying your interest rate for a shorter amount of time. The second reason is that the interest rates are lower by as much as a full percentage point. So if you think that today you're hearing about folks that may have a 3.5% interest rate on a 30-year mortgage, if that same borrower had a 15-year mortgage, their interest rate might be around 2 or a little less. Okay, so those are two of the things that you want to think about if you're considering a shorter term mortgage. And when I say shorter, something less than 30 years. So rates do vary among lenders. And when I say lenders, I mean mortgage lenders. So as an example, you say, well, who's a mortgage lender? A mortgage lender could be the bank that you currently bank with. Bank of America is a mortgage lender. Wells Fargo is a mortgage lender. If you bank with a credit union, CQ, State Employee Credit Union, they are a lender. MICU, Municipal Employee Credit Union, that is a lender. They all have loans. And then their mortgage companies, all they do are loans. They don't lend money like a regular bank for anything else. All they do are lend money for mortgages. So a couple of my mortgage partners, that's all they do. One of my favorite mortgage lenders is Hometown Lenders. That's all they do, mortgages. Okay, so there are a variety of types of lenders. They have a variety of rates, and some of them have shorter terms than others. So before you settle on a loan term, always compare official loan offers. We kind of call them a loan estimate. And I like to tell my buyer clients, if you are about to embark on a home search, this is the time where you want to talk to a couple lenders at the same time. It's kind of like when you're going shopping for a car. You want all the car dealers to pull your credit at the same time, so it's not as much of an impact on your credit score. Same thing when you are looking for a mortgage to purchase a home. You want to do it all around the same time. You don't want to talk to a mortgage lender in February and then wait and talk to one in May. Okay? You want to be really purposeful about your mortgage search, just as you're going to be about your home search. Okay? Let me see if we have any questions in the chat so far. No comments. Okay. If you have any comments about anything that I'm presenting, feel free to drop it in the chat, in the comment, or wherever you may be seeing this so that I can respond either now or I'll come back. Okay? So we're talking about the loan terms. It could be 10 years, 15 years, 20 years, or usually the max is 30. Now, I'll tell you, I have seen 40-year mortgages. Yes, I have. However, let's try to stick to 30 or less, okay? That's my professional opinion, all righty? So let's talk about interest rates. So I just mentioned that briefly, interest rate types, okay? So you're hearing a lot of conversation in the news about the interest rate. So the interest rates, they typically come two types of interest rates, whether they are fixed interest rates or adjustable interest rates. And when I work with, I do work with buyers, I work with folks who are interested in selling their home, and then I talk with sometimes sellers who are thinking about selling their homes, and I begin to ask them a bunch of questions. Or they said, well, what I'm going to do is rent this particular home out and buy another home. And so one of the questions I'll say is, how much is your mortgage balance? Meaning, if you were to pay a mortgage off today, what would you need to pay off? $90,000, $150,000, $200,000. That's the payoff, right? That's how much mortgage might be left on your home. The other type of question I tend to ask them is, what is your current interest rate and what type of interest rate is it? Is it fixed or is it adjustable? And despite the fact that we have had amazing fixed rates, probably over the last 7 years or so, there are still homeowners with adjustable mortgages. So let's talk about them. The choice between a fixed and an adjustable mortgage does affect whether your interest rate can change, whether your monthly principal and interest payment can change, and by how much, and how much interest you will pay over the life of the loan. Now, your monthly payments are more likely to be stable with a fixed rate loan. And I say likely because your interest and your principal are only typically two of the 4 to 5 parts of your mortgage payment. And you know, we've talked about this before. Your mortgage payment consists of PITI, and then there's another I. So it's your principal. How much did you borrow on this house? $300,000. Your principal, the interest, right? And we have interest rates that determine how much of that is your interest payment, your taxes. And so depending on where you live, every house has a different amount of property taxes. That's the tax part we're referring to. The first I is your insurance. It is always advisable to include your property insurance in your monthly mortgage payment. There are some homeowners that pay their property insurance separately. If you are paying it in your monthly mortgage payment, that means that whatever the insurance company quoted you for your interest payment, for your property insurance payment for the year, if they said it would be $1,200 a year to insure your property in case of anything happening to it, you usually will divide that over 12 months. So you're paying $100 a month if your premium is $1,200 a year. So you are paying 1/12 of your property insurance every month with your mortgage payment. The other I is your primary mortgage insurance. So if you don't have 20% interest already, 20% equity already in the property that you own, which means if you put 20% down when you purchase your property, you don't have private mortgage insurance. But if you've only put 3.5% down, which is the minimum for an FHA loan, that means that you don't have 20% equity in your property, and so you're going to be paying private mortgage insurance. That number varies depending on the price of the home, okay, and how much money you put down. It could vary. It could be $50, $100, and that is why I said to you, your monthly payments are more likely to be stable with a fixed rate loan, because we know your principal is fixed, your interest rate is fixed. Your property taxes may vary a little from year to year. And then, of course, your primary mortgage insurance will be in there as well. Those are the items that you want to consider. So if you want certainty over the long term, that fixed rate may be your best option. Let's stop there for a minute. Any questions? Put it in the comments. In a fixed rate loan, your interest rate and your monthly principal and interest payments, they're going to stay the same. But that doesn't mean that your total monthly payment won't change. And that's what I just discussed. That loan payment can go up or down depending on the changes in your property taxes, your homeowner's insurance, or your mortgage insurance. So let's talk about that mortgage insurance for a minute. There are companies that actually provide that mortgage insurance for the lender or the mortgage company, okay? And those mortgage companies, they actually do business with different companies. So it really depends on the company that you get your mortgage from, who they get their mortgage insurance from. So that rate can vary as well. So as you see, there's a whole lot behind this whole mortgage payment thing. And today I'm really trying to give you a basic understanding. So when you speak to the mortgage officer or the loan officer, you're going to be able to ask these questions. Let's just switch gears now and talk a little bit about mortgage that is adjustable. Now, I see a question, is there a difference in loan down payments for 30 versus 15 years? And that's a good question, Joe. So the down payment has everything to do with the type of loan you're getting, not the length of the loan. So I have had Borrowers who get a conventional loan, that conventional loan based on their profile, their credit score, their debt, their income. Okay. That is what's going to determine whether that borrower will put down 5% on a conventional loan, if they need to put 10% down on a conventional loan, or they may choose to put 20% down because they've saved 20% down to purchase a home. So there are different down payments. It just really depends on the loan product. That's what we call it. It's not so much whether it's a 15 or a 30-year loan. Okay? Great question. So I see a question here. Is it a seller's market or a seller's market now, given the rates? It is still a seller's market. We are absolutely in a seller's market. And what that means is there are more buyers on the market than homes to buy. That's what makes it a seller's market. So when a seller is in a position to sell their home, they put it on the market, boom, there's so many buyers that are interested. If it's priced right, and if it's positioned right in the market, it shows well cared for. Okay, so that is a really good question about generally what's going on in our market today. So back to the types of mortgages. We just talked about a fixed mortgage. The other type of mortgage that you tend to see is an adjustable rate mortgage. It's also referred to as an ARM, A-R-M. Okay, they offer less predictability, but may be cheaper in the short term. It might seem like a terrible idea, but an example of when this would be appropriate is if you plan to move again within that initial fixed period of an ARM. So you say, well, what's the fixed period? I don't know. It just depends on the loan that you're about to embark on. And that's the question that you want to ask the loan officer. They may say, we have an adjustable rate mortgage that's available for you now. In the first 5 years, your interest rate is 2%. After 5 years, it bounces to 4%. You may have just relocated because of work, and you know that your job is going to move you in the next 3 to 5 years. So you may purchase a home in the new area that you live in, the new state that you live in, with an adjustable rate mortgage because you're able to get a mortgage at 2%, which is less than you would get on a fixed mortgage. So that's an example of when it may be appropriate to go with an adjustable rate mortgage. In this case, those future rate adjustments may not affect you. However, if circumstances change, as they often do in life, and you find yourself in that house longer than expected because your job didn't move you as they thought they would, you may end up paying a lot more over time for that house. In the later years of that adjustable rate mortgage, your interest rate would change based on the market, and your monthly principal and interest payment could go up a lot. They may even double. I'll give you an example. I have a past client who called me very recently, a few weeks ago. Her mortgage was an adjustable rate mortgage, and it was an adjustable rate mortgage. It adjusted. Her mortgage payment went from $1,600 a month to $3,000. Not that the principal changed, but the interest rate changed. You know what kind of life-altering change that is. If you know you've been budgeting for the last 5 to 7 years, paying a monthly mortgage of $1,600 a month, and now it's $3,000, that is a really, really uncomfortable place to be in. But it happens. And that is one of the things you want to consider in the market we're in right now, because the fixed rates are so low. So take a look at your documents, see what your interest rate is, and decide whether or not that interest rate type, if you're in an adjustable interest rate, is something that you want to reevaluate now so that you can take advantage of these amazing low fixed rates that are available right now. Okay. So, not sure if you have any questions about the interest rate type, but there are two types, fixed and an adjustable. Okay. So let's move on to the loan type. And that was a question that was asked a little bit earlier. So mortgages are organized into categories based on the size of the loan and whether it's part of a government program. Okay. Deciding which loan type you will select or move forward with will determine how much you'll need for your down payment. And that was the question that was asked before. How much do you need down? Well, it depends on the type of loan that you qualify for, and then you then select. I have buyers, they qualify for both. They qualify for a FHA loan and they qualify for a conventional loan. That's the first thing you're going to figure out. Then they're going to look at the terms of the loan. Is it 15 years, 20, 30 years? Then they're going to look at the interest rate. What's the interest rate for the FHA loan? What's the interest rate for the conventional loan? Then they're going to look at how much down payment will I need for my FHA loan? And all of you who've been following me, you know what that is. Drop it in the chat. That's fixed. It's always going to be the same down payment on an FHA. The conventional loans can require different amounts of down payment. Okay, so deciding which loan type you're going to move forward with, once again, will determine how much you're going to need for your down payment, the total cost of your loan, including your interest, your mortgage insurance, and how much you can borrow, and the price range that you can consider. That's where we then go shopping, okay, this whole price range. So you're going to say, okay, Gersha, I'm qualified for $300,000. It's a conventional loan. The interest rate is 3%. I only need a 5% down payment. You've already saved your money. You have your 5% down on the $300,000 purchase. You know what that monthly payment will be because you've talked about that interest rate with your loan officer. That had everything to do with your credit score, the amount of debt that you have, and the amount of income is what determines your purchasing power. All of those things. So when folks say to me, well, how much, I make $80,000 a year. How much house can I afford? Well, as I said, we got to consider some other things. How much debt do you have? A person who has $25,000 worth of debt with an $80,000 income is going to be able to purchase less than a person who has $80,000 income and no debt. Okay, so each loan type is designated for different situations. Sometimes only one loan type will fit your situation. Some buyers have multiple options. So if multiple options are available to you, you'll want to explore different situations and ask the lender to provide several quotes so you can see which offer best suits your needs. I always say this, the loan officer, the lender, they're going to provide these scenarios, but only you know that in 3 years, you're going to have to put students in private school, or in 4 years, you're going to have a college tuition, and 2 years after that, 2 college tuitions. Only you know that there's a plan for your family, which may be a 2-income household right now. You have a plan to become a 1-income household. You only know that in about 3 years, you may be embarking on your own entrepreneurial venture. So today you qualify based on the fact that you're a W-2 earner, but in 3 to 5 years, your side hustle is going to become your main gig. And so you begin to think about what is going to be most comfortable for me. And that is why you have to explore your loan situation for yourself. So most of the time, you're going to think of either a conventional or an FHA loan. A conventional loan is what most loans fall into, and they're typically cost less than an FHA loan, but they could be harder to qualify for. FHA loans usually have a lower down payment. Let me see if anybody put that in the chat. Anybody put that in the chat? Okay. Down payment. If you know what the down payment on your FHA loan is, drop it in the chat. So FHA loans usually do have a low down payment, and it's 3.5%. Okay. And they are available to those sometimes that have lower credit scores. Okay. You can still buy a house. Your credit score isn't up there with the 700s. You still qualify for a mortgage. It may be an FHA loan. You have less money that you have to put down, 3.5%, but your interest rate might be a little higher than your friend who is qualified for a conventional loan. Okay? But you could still buy a home just like they will. We just got to figure out, what is your monthly payment going to look like? Is it comfortable for you? Okay? So other loans that are available are VA loans. Those are backed by the Veterans Administration. They are for veterans, service members, or their surviving spouses. Okay? And a lot of folks don't realize this. If you had a spouse who passed, you may still be able to use their VA loan benefit. Now, what is the biggest benefit of a VA loan in terms of a down payment? Hey, Scotty, thanks so much for joining. Anybody can tell me, what is the biggest benefit of a VA loan? What is the down payment if you have a VA loan? Anybody know what that is? Just jot it in the chat. I'm going to go ahead and I'm going to talk about a second type of loan that a lot of folks haven't really heard about. It's called a USDA loan. United States Department of Agriculture. Yes, loans. They're made available to low to middle income borrowers in rural areas. So those of you, my friends, that are here in the Baltimore County area, in the Baltimore metropolitan area, in the state of Maryland, we actually have areas that are designated for USDA loans. So if that is something that might be of interest to you, hit me up, Google it. There are parts of Carroll County that qualify for USDA loans. It doesn't mean that you're on 10 acres. It doesn't mean that you're far away from a metropolitan area. They're just designated areas that qualify for this USDA loan. So take a look at that, look into it, talk to your loan officer about it, and find out, do you qualify for USDA loan? Did anybody tell me what that down payment is on a VA? No, I don't see a comment yet. So I'll go ahead. I'll let you know. I actually have 2 borrowers now who are walking through the process of a VA loan. And the VA loans require zero down payment. The borrower still has the regular closing costs that most borrowers have to invest in the purchase of their home, but their down payment is zero. So if you believe that you may qualify for a VA loan, let's have a conversation. Because if you don't have any money saved up for your down payment, but you have enough for your closing costs, you could get in the market. You can get in the market now, okay? The third type of loan I want to talk about, they're kind of local loans. They're determined by the local government, and they're often, once again, for low and middle income borrowers, first-time borrowers, and people who work in the public service. So we know, I'm going to take a minute right now, once again, to thank all of our public service employees, all of our frontline workers, our teachers right now, all the people who are trying to get these vaccines so they can help us all get back to things to be as pretty normal as we can get them to be. So there are loan programs for first responders, down payment assistance programs for first responders, those who are in the medical fields. There are loans for physicians. There are loans for podiatrists. There are a number, and we're going to kind of lump those into those local loan categories that have different terms than some of the other loans we've talked about today. Okay, let me see if we got any questions. So here's a question. If you qualify for FHA, what's the advantage of providing more than the required down payment? Well, the advantage of putting more, so we talked about the required down payment was 3.5% for an FHA mortgage. The benefit is if you can put 5% down or 10% down, what you have just done is you have moved more towards having more equity in the house that you own. The loan is no longer being financed at 97%. It is being financed now at 90% or 80% because you're putting 10 and 20% down. So the amount of your monthly mortgage is less because you didn't mortgage as much of the purchase price. You put more money down. Okay, so if you want to be in a position that you're getting closer and closer to having 20% equity in your home and you no longer have to pay private mortgage insurance, then that's why you may want to put more money down on an FHA loan. If you want your mortgage payment to be less because you're not borrowing as much, that's why you want to go with an FHA with more money down than what is required. Okay, I'm hoping that was helpful, Josephine, but that was an excellent question because there are borrowers who have cash, but their credit score might not be very high. And as a result of that, and so you say, well, how does somebody have cash and their credit score isn't that great? Well, they may have just come into a settlement due to a lawsuit. They may have and that means they have, a sum of money based on the fact that they settled on a lawsuit. They may have inherited some monies because somebody passed and left them a significant amount of money. And they're like, yep, I'm going to buy a house, which is one of the best things to do when you do inherit money. So their credit score is their credit score. But now they have 5% that they could put down, and they have 10% that they could put down because they have received an inheritance. If you hit a little bit of the lottery here or there, or have gotten money from any other source, that's how a person may still have a good credit score, not a great one, but a good one, qualify for an FHA loan or a conventional loan, but they just have access to some more cash. Okay, so that's how you could be in a position such as that one. I know we're going a little longer today, but I'm telling you, this whole loan thing, it has many layers to it. It can be confusing. It can be a little difficult to grasp, and that's why I said take some notes, jot down some questions. If you'd like to have another conversation, feel free to schedule a house call with me. The link is here in my Facebook page. You can find it on my Instagram page, or you can go right to my website and schedule a time to talk with me, and we can go deeper into your specific situation around mortgages and your planned home purchase. If you're just joining us, I'm Gersha Porter, the CEO of Porter Premier Homes of Cummings & Company Realtors, where we eliminate confusion for buyers by giving them key strategies to unlock resources to buy their dream home. And we provide the same kind of service for our sellers who are either thinking of refinancing, they're thinking about downsizing and holding on to the current home they have and renting or buying a smaller unit, or they may want to sell completely. We are able to work with you in that respect as well. So those are the pieces that I wanted to go in detail with you. So if you are interested in learning more about home loans, drop it in the comments, send me a direct message. You could reach out to me at 443-744-0206. Let's talk about it. There's no need to sit there digging into or going down the Google rabbit hole. There's so much information out there. It's going to be really important that you can have a conversation with someone who can ask you pointed questions to understand where you would settle in the various choices we have for the mortgages. Any questions? Let me see if we have any new questions. All right. So if you do, I will go back to this live, check for any questions, and I'll make sure to respond to your questions. Yes, it is Wine Wednesday still, and I want you guys to know that on Saturday, February 27th, that my wine team, we're going to be doing another virtual tasting. So if you're interested in sampling any of the featured wines that we have, it's not too late to order your wine, and you can join us online, learn more about the different wines that are available for you. All right. So if you haven't already, please join our Facebook group at Own Again. You can go to www.gershaporter.com. It'll take you right there, or you can find us out there on Facebook. And we're going to be talking more and more about the services, the coaching services that I'm going to be offering for my current tenants who are looking to own again. All right. Book a call with me if you want to own again, or if you're just interested in talking more about real estate. This is my link, and I'll make sure to go back and put that in the comment So just as a reminder, I'm here every Wednesday for Own Again Facebook Live, Wednesdays at 5 o'clock. And I'm still super involved in the Thousand Black Families Initiative. If you participate in that program, we have some loan officers who've agreed to give our buyers additional monies towards their down payment and closing cost. So if you're interested to know whether or not you qualify for that, you can message me as well and we can talk more about that. If you haven't already liked and followed my business Facebook page, please do. When you go on Facebook, it's Porter Premier Owns. I really do appreciate you taking the time today to listen more about loans, what loan types are available, how they may work for you. If you're having conversations with some of your friends and your family members and you want some clarifications, let's just set up a Zoom call and we can have 2-3 of you on there at the same time. I'll ask them to pull out their most recent statement they received from their lender. Right on there, it shows you your interest rate. Right on there, it tells you what your mortgage balance is. Right on there, sometimes it'll tell you if you have an FHA or conventional, and if not, you can just reach out to them and they'll clarify that for you as well. Okay. Well, thank you again. I really do appreciate you hopping on today for this segment of Own Again, our Facebook Live with Gersha Porter. And don't forget, if you are interested in setting up a time to talk with me, I'm going to make sure I put the link in the comments. And enjoy the rest of the week. Those of you in this Baltimore metropolitan area, please stay safe. I know we're expecting some snow and we want everybody to be as safe as possible. Take care. Have a good rest of the day. Bye-bye.